Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, February 3rd, 2023. So the big week is over. We have the Fed, the ECB, the BOE out of the way, all the big central banks. We have Apple, Amazon, and Alphabet out of the way, and that to me was the biggie. And so now, feel the risk is a little less getting back into the market. Again, whether long or short, you don't have the as big a risk of a gap. But of course, here we are, as I said, a week ago when those were out of the way, it would be a Friday. So Friday is that one day that even future traders have overnight risk. In fact, 2 days of overnight risk because the futures, although they trade almost 24/7 Sunday night through Friday evening, they do shut down and Friday on the stock futures and then pick back up Sunday evening. So anyway, that's where we're at. So nothing. Again, I don't see any reason to go crazy long or crazy short, meaning heavy positions. But I did, as I told you, I would took home starter shorts on the indexes, Nasdaq, and overweighting the Nasdaq with a secondary position in the Russell 2000 small caps. That's the setup yesterday. This is just that 15-minute chart. Just want to show you, which I did this morning. We hit to the button, the top of that pullback support zone right there, bounced. Told you that's where I added a second lot there. And, this is what needs to go. So I have an alert set for next week. If we can take that out, let me show you. That's on a, well, right there. That's really today's low. You can see this is a 5-minute chart. And again, this is not, even if it went in after hours, it doesn't matter. You don't take a position on Friday at, in the final hour of trading on the futures or anything like that. Best to just wait until Sunday opens up, and then really Monday, that's when all the institutions come on. But so that's just short term. That's what needs to happen. Pretty much a break of today's lows. The bottom of that range was right here that I had under here. I'll put a line there on this 5-minute. But being that we already tested that level, I think a break of that would do it. And again, that's just a short-term 5-minute chart. The 60-minute chart right here is where you have the primary trend line on the 60-minute time frame. That comes off these lows right here, right around the beginning of the year. So here's the whole rally year to date so far, month to date, year to date. Well, actually, we're in February, so year to date. And there's that same support level right there. So that's it. I'm going to need to break that and come on down here, and that trend line will be a big, I think that'll be a pretty big deal. But again, we're going to now turn our focus to the daily charts. This won't be a long video. I'm just going to go over how we close the week. So this is QQQ, my busy board, I call it, and then the clean board right here. That's what happened today. We had a big spike up. I'm going to show you something pretty interesting on Apple and QQQ on the 60 when we get there in a second. But that's where we're at. So bulls right now. The ball, they still have advantage, if you want to call it, because they're above the 200-day moving averages, above the trend lines, and everything else. So the bears have their work to do. So again, that's another reason it's not an all-in short moment, in my opinion. And that would be a break of the trend line right here, the uptrend line, a break back below the 200 days. Obviously, that trend line, it's not a single event. I just want to say that out. It's more of a zone. If we start to drop through there, you get check marks. And based on where we're at, if it's going to happen, it'll probably happen fast. That's usually how it works. What I wanted to show you is we can do it here on the 60. Let me see if I want to do the 60. No, we'll do the daily right now. If you look at the volume, where volume spiked to yesterday on that big up day right there, this is the daily chart. I'm putting the volume, you can see my volume bars at the bottom, these gray bars. That was the highest volume since this day right here. It was almost exactly the same volume. The volume bars at the same level, and that was on a just about as big of an up day. That was December 13th, and you can see that marked the end of a rally. That was a buying climax. You look for volume surges; they can often mark buying climaxes. They can also accompany breakouts. Remember, the breakout came just before, but that is a potential buying climax. I'm going to show you something on Apple too here in a second. So I just want to rifle through the big fangs real quick. The market leaders, show you how they look today, how they close today. Apple got rejected here, right off that 157.50 level, which was that previous reaction high right there. You can take that line back, but that's really the big resistance. And interesting to note, you have, let me turn off all the lines real quick. See this candle, today's candle? That, remember, that's the post earnings. They reported yesterday, but that's not reflected in yesterday's candle. That's a regular session. So this is everything in response to earning. They ran it up hard, and that candle looks like almost a mirror image of that candle, which was exactly the same thing. That was the 10/28 October 28th candle. They reported on October 27th after the close. You had the same exact volume. That's that. There it is right there. Let me put my line up. Here's my volume bars. If you can't see them in the video, I have them turned down a little bit. It's there. That's the biggest volume yesterday. No, today. I'm sorry, today, with today's big green candle, and it matches that volume exactly. So it doesn't mean it's going to repeat, but it is, that's what technical analysis is all about, is identifying current patterns in the market, and then looking back and seeing what happened in the past when you had similar price action, similar chart patterns. That's how technical analysis evolved. People probably started noticing wedges, cup and handle patterns, head and shoulders patterns, support, resistance, all that stuff, and then over the years it evolved. So anyways, just wanted to point out the similarities and Apple has, from my experience, a tendency to kind of peak on earnings, and Apple is an earnings juggernaut. They're always it was one of their worst reports in years. That I will say, I think it was the worst one in 5 years. But yet the market still bought it. Market wants in right now, and again, they want in because they see this. They didn't, majority didn't want in here. This is where the masses seem to be buying. Just like right here, you had a big that bearish or bullish engulfing candle, then the pop. But that bullish engulfing so far didn't prove to be the bottom in Apple. So anyway, I just wanted to point that out. This time, the only thing different, well, there are some differences, and I do have to acknowledge that. That time, you also ran right into the 200-day simple moving average. That's the blue line there. This time around, we had taken it out the previous day, and we closed the day on it, well above it actually, off the highs, but we did get rejected at the same point. So I did just want to point out those similarities in candlestick, volume, earnings, and then what is different again. So the fact that we're above the 200 gives you, unfortunately, a little not as strong a case to have shorted it as you had back there. But of course, if it fails, as I always say, in my opinion, fewer things in investing or trading and technical analysis are more bearish than a failed breakout. So if all this gets erased and we go down and we clearly take out this uptrend line in Apple, which just like you had back here, and just like you had right here, that's what I look at. I'm big on trend lines, support, resistance, but I take it all in. I look at volume, everything else. And so anyway, that's what we look for next week. So Apple gets a check mark for the day. That's just a similar setup, but nothing bearish yet. That turned out to be bearish once that big green candle was wiped out. Once all those lemmings that piled in right there realized that they bought the highs, that's when the bottom fell out and Apple went down. They tried to run up again, got right back to where the masses bought it, that big green candle. It got rejected again, and that was bearish for Apple. So that's what we look at. If we get another rejection at that level, that is very technically significant, but not just a 1-2 day. You got to really start walking away and pretty much, I think, take out the bottom of this gap right below, and then this little consolidation period below that. That's where it should really start to sell to the downside, accelerate to the downside. Microsoft, let me go back to my clean boards. Very simple. Rejection at the BOD or uppermost trend line right there. Comes in off the high, all-time high in Microsoft, catches that next high, catches this high right here, and boom. So far, I'm not going to call it a rejection. It's just we hit the trend line, we're consolidating on it. Slightly rejection because we closed below, but again, to do the damage, you got to come on down quite a bit and start walking away. That's like this. So we'll watch that next week. Alphabet. This one's interesting. There's this is a questionable trend line. You have a few reactions here, and now let me pull that down. Let's do that. Let's clean it up. Yeah, you could call it a third now distinct reaction. Absolutely. So let me try to grab the line if I can. The chart program is not cooperating because I have another line there. You got to move them around sometimes, do that, and sometimes that's easier to do it like that. All things moving together. There we go. Oh, so now 1, 2, 3 distinct reactions because we hit it yesterday and reversed pretty hard. That is a rejection off that trend line, and that's a reaction. That's what is to me the validation. If we just went through it, there was no reaction, but you hit it and then bounce. And we also look at that. Reject. We popped the 200 days on a single day, 1 day pop above, and then post earnings we've been rejected. So the market did not like so far what Alphabet was selling. They thought they would. They rallied it up into earnings, but this is the post earnings candle. It's not huge. And again, you can say, well, it's profit taking after a heck of a run, so it's not, an all in, oh my gosh, that's super bearish, but it certainly isn't bullish, especially the earnings if you're more of a fundamental guy than a technical guy or gal. Yeah, they weren't, earnings weren't so hot. And here also, that's a big rejection right there. That is big. This was trading range that went on all the way from early to mid-April to mid-September. Super well defined, especially the bottom of that range. Broke it there. That was a major technical event. Big sell signal. Rallied, tested, checked it from below. Hard rejection, and now another rejection so far. So again, farther we get away, then the more that firms it up. Now, if they can power on through there, powerful. That's bullish. You've taken out the 200 days, you've taken out the trend line, you're back into this trading range, which means you could easily head to the top of it. So this is what I'm watching for next week, favoring some more downside, at least some backfills of these gaps, tested these uptrend lines, and quite possibly more. I'll let you know my thoughts then. In other words, these shorts from yesterday and today, right now, you don't want to label them. I don't, you can label them swing, 1, 2 day, 3 day swing if we hit these targets next week. Or possibly add to them and hold them as potential trend positions, a trend for the next leg down. Lots of work to be done for that. But it could happen fast. That's the thing. Lots of work doesn't mean it necessarily takes a long time. It just means we need to see some movement here, some pretty big red candles next week to say that, wow, that was a rejection and a false breakout there, and we're likely headed lower. Amazon. Smacked down hard at the 200s. That is a rejection right there because you hit the 200s yesterday, and from yesterday's highs to where we closed today or fell to, that's almost a 10%, 9% drop in Amazon. So that's glass half empty or bearish, the rally into and rejection off the 200, just like you got rejected off the 200 simple there, the 200 exponential there, 200 simple there, exponential there, simple, you get it. And that's where you first gave them up. That was your sell signal. And every single time without fail, including yesterday, we've been rejected off the 200s, and they both came in together. So it was rejection off the 200 simple and exponential. So that's glass half empty, right? However, glass half full, this was big support. That was my key support. It was a long-term downside target I had on the weekly. We bought it there long, traded the bounce off there. But then ultimately, and that's the thing about my targets, usually you hit the initial reaction, you get a tradable bounce, and then ultimately support, especially in a downtrend, after you get that initial rally or bounce off it, then it tends to go. So just like that, it's kind of like what happened this morning. Go back to the very short-term time frame, that 5-minute chart. That was the first pullback target I had, and it was checked this morning at the open. That's the reaction, and so therefore I favor. Well, we got there, but we went all the way there. We closed just above it, so that's why I favor. I think next on Monday we're probably going to gap down below that level would be my guess, because we already had the tag off the initial pullback in tag of that level. And so the same thing kind of holds true here. Going back to that chart, Amazon has, back here, this is what I was talking about. So we bounced, then we took it out. Once it support's broken, it becomes resistance, rejection. Now we took it out here, and so I'm going to give Amazon points right now, until and unless. But if it fails that level, and the more, again, it's not a super hard line. That means I have that number at 103.49. It doesn't mean if you go to 103.48, it's lights out for Amazon. It just means the farther you get away from there, and then the next support's going to be back test of this trend line here, and that's where the buyers should step in, and maybe they do, and it's probably going to. You probably, if you do fall that far, you probably see it bounce, and then at that point, if you do trade a bounce off here, assuming that Amazon does go there, and then assuming that it does bounce, that would be your next resistance, 103.49, where you could exit a long, or initiate or add to a short. All right, so we'll see. Lots to watch next week. That's why I'm doing this ended week wrap here. Tesla. Somebody asked about Tesla. I've been covering this in the recent videos, but I just wanted to reiterate. This is the blue lines here, or on the clean board, the white lines, that's a resistance zone. We hit the bottom of it yesterday pretty much, and again today. It's defined by that reaction high, that one there, reaction low right there. We have reaction highs there, reaction highs there and there. Coming back here, you can see all back here it was support, here it was support, here it was support. Then when support broke, you back tested it, failed, resistance. Another back test at resistance, fail, and a rally into resistance. Not just a rally, an extremely overbought rally. Overbought measured not just how much it went up percentage terms, although that's pretty significant, but that's again the nature of this beast. This is Tesla. Tends to move big, but that's 93%. We caught most, not all of it, unfortunately. I didn't milk every penny on that, but we were long here. It was one of my favorite trade setups in that bullish falling wedge right there, right before the wedge broke out. So that was 82% ago. But again, look at it. You can see it here on the 60-minute chart. Big resistance, even carried past what I figured would be the most likely max target there that I laid out back here, 167.50. But it doesn't matter. We took that level out, and that's even bigger resistance. This was, one, two, couple reactions, then a breakdown. This one, look, multiple reactions there for support, breakdown, back test, back test. So whereas that was a resistance level, this is an even bigger resistance level. And this, my friends, is negative divergence, one of my favorite things. I like, just like the positive divergence said, we're likely to rally if we could pop above the trend line, which we did, the bearish falling or bullish falling wedge. All right, so this one is, you can use it as a pure play. It's still trading in the after hours. Minimum target, if you wanted to short Tesla right there, is 11% drop down to the uptrend line and that 157. It's also a likely reaction point. This is what I call kind of a high probability trade. Go down there, catch a bounce, ultimately probably break down based on the divergence. But again, you get 10, 11% on a quick trade. You might want to cover, or you can if you shorted it here or anywhere around here, just lower your stops and hold out for the big prize, which would be a breakdown and another move down, maybe a back test of the trend line down here. But again, if that does pan out next week, and no guarantees, of course, 11+% drop in Tesla, that's most likely going to put pressure on the markets. You're very unlikely to see Tesla drop 11% and Amazon, Apple, and Microsoft all go up 5-6% next week. And Nvidia, I like to cover that in with the big techs because it does have a high weighting. It's much bigger market cap than even Meta now. Negative divergence on the 60-minute time frame, and as covered yesterday, pretty much a brief momentum fueled overshoot of that 208-ish resistance level there. Big level. That was big support here. Once it broke, it was lights out for Nvidia, and this is the first time back testing that. And you have a nice clean uptrend line, just like QQQ has a clean uptrend line down below, and maybe even SPY. Let me see, does SPY have that? Let's populate, let's change boards here. Yeah, there's a trend line. So watch these trend lines. These are minimum targets just to pull back for the overbought conditions. And I do everything. I try to provide analysis for everybody out there. That's my job. It's not a follow me site, trade what I'm trading. No, I provide technical analysis. You decide what to buy or sell, and I'll tell you if you're bullish and you think that this was the end of a bear market and the beginning of a new bull. You buy pullbacks to support. It's very simple. So you buy pullbacks to that trend line. If that doesn't work, you buy the pullback to the next one, and or the 200-day moving averages, which are just below. And if you're bearish, then you short and you continue to add to those shorts if and as each of those levels break. That's the only difference. Those bullish should be buying pullbacks to support. Those bearish should be waiting for breakdowns of those support levels to add to short positions. Excuse me. And to finish it off here, let's just go through those sectors I went through yesterday and see what happened there. Remember, like color coded with purple circles, the probably the big levels to watch. XLK is the biggest tech sector in the S&P. Same trend line right here, this uptrend line. You want to watch that, a break of that. And this right here, this whole circle shows that's where you took out, or the tech sector took out the 200-day moving averages. So again, same thing. Bulls can buy pullbacks there, bears can short for the aforementioned reasons. Be short tech now and the market, and or to be short or long tech is to be short or long QQQ. It's really one and the same. And then short the break of the trend line, short a failure back below the 200s, and especially back below this uptrend line. In other words, that if that purple circle, that was our breakout, which now really should be up this. If that is clearly taken out with the tech moving down here, then that means that was probably the biggest bull trap of the last year, at least, right there, bar none, with everything taken out, the trend lines, the moving averages, and everything else. And if not, then hey, guess what? Those are levels to buy, and I may be, not right away. I'll let you know next week if I'm going to get on board the bull train. I'm also an in and out active trader. Even if I maintain a intermediate to longer term bearish bias, I can go long, short. I told someone the other day I do up to, I do literally thousands of trades a year only in my trading account, and then I have multiple other accounts, personal and family, that probably add up to another 1,000 or so trades there in a year. And so it's in and out, long, short, sometimes long something in one account while I'm actually active trading, going short, getting the little what I call micro squiggles in a trend. If this is a trend that I see coming, as an active trader, I'm doing this. And as an IRAs and other accounts, I'm long here, and then I'm get out there if that's where I think it's going, and not try to do all that active trading stuff. It's just impossible to log on and log out and try to manage too many trades and too many accounts. All right, so there's tech. Still, this is just something to watch for. No bullish or bearish crossover yet, not even close, but we'll watch that. And not extreme overbought, but we are overbought. This is the RSI, the red line is a 70 level, and that's usually what does the trick in a bear market. I had the purple line here. In a bull market, overbought is a higher level, and for a while there I had that line at about 81.41. That's what it took, in a bull trend to really cool things down. But in a bear market, and so far since the bear market started, all you have to do is run back to the 70 level. That's what happened here, and that's usually the end of the run. So time will tell if this is early stage bull market action or just another run-of-the-mill bear market rally. And hopefully next week will be that time that will tell us. Downtrend line on XLV, healthcare sector. PPO looks like it wants to curl up, but it hasn't done so yet. So still pending a bullish crossover. Sometimes you look like you're going to cross, or you do get a little whipsaw, and then you get rejected and continue lower. All I can tell you is we've had the 3 failed breakouts to the upside so far, and we're back in the channel. We had the 2 false breakouts to the downside, and the MO is typically once you re-enter the channel from above or below that you go to the other end. So, but again, this would show us a change of character if we only pulled back a little bit in the channel and then turned around and broke out again and ran back to those highs. That's going to show strength in the healthcare sector and in the market, which is the second largest component of the S&P 500. So definitely something to watch. XLF financials, busy chart, I know, but 36.78 was big support back here. Again, I know it's very busy. I can try to see if I have a clean version. That's just fibs. It's my fib board right here, but with the Fibonacci retracements from the all-time high to the low, that measures that, and we hit to the button the other day. And there were a lot of sectors and indexes too, and other key stocks hit some key fibs yesterday and or today. That's the 61.8 Fibonacci retracement, again, from the entire move from the all-time high down to the so far bear market low. And that's a typical counter trend retracement in a bear market. You hit the 38.2 fib there, you had a reaction off that, then you hit the 50 here, pulled back, went a little above, and that's we're at the 61.8. But the other things that stand out, And I'm going to go back to my busy board because we now have, as of yesterday, really negative, or just recently, we just put in a marginal new high, and so we have negative divergence there. And negative divergence at resistance in a bear market, to me, that is all I like to see. That's enough to say that I would give it very good odds that we're going to have a tradable, swing tradable correction. So consider this a trade idea. Unless, what I would say is I'm getting it out to you after the market's closed. If you pop up big, don't short financials. But if we open at or below that 30, call it about $37 level, absolutely objective to short with a stop somewhat above. Targets would be based on that negative divergence and based on the fact we're in a bear market. I wouldn't even want to lay out targets. I'd just say short it, tuck it away with a stop somewhat above, let it ride for now. And if it starts to pan out or I get any requests, I'll give you targets. But looks like JP Morgan already broke down and it's at a comparable resistance level. So I think there would be a lot more downside. And of course, we'll see what the market does. We're going to need tech to roll over sooner than later to take the rest of the market down with it, of course. XLY, I know another busy board, but there's your primary downtrend line off the highs right here. We popped it yesterday, but tested it, closed right back on it today. So it is still a breakout. But if we go down much lower and there's your uptrend line, that breakout is at risk of failing. And if it does fail, you can see you have just below it the 200-day moving averages right here. And that's where that trend line comes in. So in other words, anything much below here will mean that this whole breakout it was a false breakout, aka a potential bull trap. Also overbought, again, overbought in a bear market, very overbought. Tells you, be careful there on the long side. XLI Industrials, just yesterday gave us a new and divergent high. That's the only thing I think I've added to these charts, the purple lines, since these purple circles, since I did this yesterday. I wanted to point out now we have some pretty big negative divergence on the industrials right there. Industrial sector within the S&P 500, which is the 5th largest sector. So it's getting close to its all-time highs, previous highs, but again with that negative divergence, sometimes it's close but no cigar, and that would be and also an objective short in my opinion, based on that. XLC, I'm not going to call it a smackdown, but it's certainly a rejection at the primary trend line right there. You got to zoom in tight. See, that's these two candles. We hit it yesterday, moved down below it today. Again, not a hard rejection by any means. There's some thin air here, that gap below us and the trend line. So again, this would be, in my opinion, probably the more bullish of the scenarios would be at least a pullback to work off some of the overbought conditions, come in, backfill the gap. Buyers should be, again, I say should be, that's where they should step in on the backfill the gap, which also comes right in with the trend line right there, the uptrend line. And if they don't buy, well, then they have the 200s just below. And if they don't buy that, then this is a big level. In fact, I'm going to set an alert, 52.89. That's a big level to me because it was support in this little trading range, broke the support, tried to back test. I'd actually make it a zone because when we back tested it, it was a little bit below there, about 52.10. So that really should be the alert, about $52. Because once you broke the trading range, back test, rejected every time, put us in that little trading range there, basing pattern. There was a breakout, that's bullish, and a back test up, down to, but not below that range could still, be bullish for the market. Anything much below that is going to be very bearish and probably just send us a lot lower. XLP, consumer staples, recent bullish crossover. I added this downtrend line. I don't have much of an opinion on that one. It's really just kind of blah in no man's land, going up and down like a wonky EKG. XLE, hugging the line. Remember, primary uptrend line. That's this purple uptrend line. Again, I know that's a busy board. I'll give it to you on a clean board. I'll just replicate it. There's the uptrend line for you right there, off the low, and pretty much flirting with it. That's the way I had it drawn before. I have this as being a little whipsaw. Let me take away that fib. Because you have enough reactions. The initial reaction, 2, a little whipsaw around through there, 3, 4, 5. If you want to make it a benefit of the doubt trend line, but then you only have 2 reactions so far. This has a lot more reactions. That's a better fit in my opinion. And then that coupled with the negative divergence recently and bearish PPO crossover tells me next week we could see likely get some downside going on the energy stocks there. All right, that's it. The rest don't move the needle. Doesn't matter what XLU, utilities, and basic materials and REITs do, because their weighting in the S&P is too small. So I'm going to wrap it up here, and we'll pick it up on Monday. This has been Randy Finney with Right Side of the Chart. Have a great weekend.